Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Today, we're going to discuss the U.S. debt crisis. What is going on? Where are we spending our money? And why this is so important right now. So, this all starts off with the debt ceiling. The debt ceiling is the limit that Congress allows us to borrow as a country. When we say borrow, we mean issue bonds. Because remember, bonds are loans that we get to invest in. And the U.S. and the U.S. dollar is one of the biggest, most safe investments out there, which everybody starts to invest in. If we don't raise the debt ceiling, meaning borrow more money, we're not going to be able to pay those bonds. If we're not going to be able to pay those bonds, everybody's going to be in trouble because you invest in U.S. bonds, whether you know it or not, your retirement funds, and then other countries also invest in U.S. bonds. And if we don't make those payments, again, everything is going to collapse, which is not good. But how do we get here, and where is the money going, and why don't we have it? So first, remember, the debt ceiling is something we really kind of made up. It didn't start until 1939, and every time the debt ceiling is raised, remember, it is always to pay for something that has already been passed, okay? So anytime you take on debt, you're paying a bill, that's for something you bought yesterday, a year ago, 2 years ago. I just paid off my student loans from undergrad. That was a decision that was made in 2008. When I started college. So that's something done in the past. So always remember that when you're watching TV and people arguing about stuff. Always remember it's something that Congress has already passed, you know, a year ago, 2 years ago, or however long ago. That is why they have to raise the debt ceiling. So there's that. But where are we spending our money, and how do we even make money? As a country, we primarily make money from taxes. Well, you make money in taxes and you spend money on Social Security, defense, so on and so forth. I'm actually going to break down each of those numbers as well. But here's the problem. When you cut taxes like we did in 2020 or even the Bush tax cuts, I think in like 2001 or so, you actually bring down your income. And if you keep spending at the same rate, you run what is called a deficit. The deficit is that gap between what you brought in and what you are spending. And every single year, as that deficit grows, that becomes the national debt. So that is how we got here, where we are $1.4 trillion in debt. But where is the money going? Here is a graphic on where exactly our money is spent. And this is as of the year end, fiscal year 2022. Now notice on the far left hand side, you see individual income taxes. We bring in $2.63 trillion from income tax. That's me and you. That's our taxes that go to the IRS and all that kind of stuff. That's what comes out your check between the gross and the net. That painful piece that is there for individual income tax. And then you go into Social Security and retirement, and then you move down and you see corporate taxes. Okay, corporate taxes. You know, a lot of times you turn on the news, they say corporations should pay their fair share. That's because we as individuals, me and you, we pay $2.63 trillion, and corporations, their income tax is $0.42 trillion. That's not close. And if you ask me, that's not fair. The numbers are the numbers. I'm not making it up. Okay, that looks a little light to me. Okay, so that's all I'm gonna say. Okay, now as we move over, you see that our federal revenue is 4.9 trillion compared to our federal spending at 6.2 trillion. So again, we bring in taxes about almost $5 trillion, but we're spending almost $6. That's where you get that imbalance. There's two ways to fix it. Either cut your spending or raise your taxes. Now, I and you, we don't want to, don't raise my taxes, okay? We already paying enough based on that graph. I would raise corporate taxes. That's just what I would do, just because that's the lowest part of the number. And I know they making money because as investors, right, we know the stock market is up right now. We can look and see how much a lot of these companies are making. So, you know, there's that. But aside from that, let's go through and look at all the things that we are spending money on. As you see here, we spend 1.22 trillion, so 1.22 on Social Security. That is our biggest expense, actually. And then you can go down the list: healthcare, income security, defense, which is 1.04 trillion. Then you got Medicare, education, interest on debt, and then other at 0.33 trillion. So the deficit, the money that gap is 1.3 trillion, $1.38 trillion dollars right now. That is where we are. Okay, mostly on Social Security, which I think most people have talked about before. And if we don't fund Social Security, that's going to run out here relatively soon. I think in the next 20 to 30 years. I'll have to look up the exact date. But You got Social Security, defense, healthcare, all that, veterans. Already mentioned defense. That is a large part of our budget as well. So that is how we got here, and that is where the money is spent. The only way to fix this, one, you really have to raise the debt ceiling. In fact, it's been raised over 70 times since the 1960s, and in fact, up until about 2011, it was unanimously passed without political fight and us running into really something that we don't have to run into. In fact, most countries don't have a debt ceiling. They just borrow what they need, they pay the debt, and keep it moving. We should probably get rid of it. But again, we put this here as somewhat of a little political football for us to fight about and then get leverage over one another. For what reason, I don't know. But it absolutely puts us in a crisis mode, because remember, back the last time this happened, I think this was in 2011, we ran up into the debt ceiling and we actually got downgraded on our debt. We used to be, I think it's a AAA bonds, meaning the best, safest investment out there, and we got notched down just a bit, meaning we are a little less safe, meaning that we are not the safest investment you can possibly have. When you invest in treasuries, we say this is the only investment that is absolutely guaranteed, backed by the full faith and credit of the United States. If we don't pass it, that no longer becomes the case. And remember, there are a lot of things that you invest in or that you put your money in that you might not know are invested in something that is related to the federal government. When you put your money in a CD, supposed to be guaranteed by the bank, you put your money in a regular savings account, the bank takes that money and invests it in treasuries. They do things like that. It's actually what happened to SVB, but they put it in treasuries to guarantee that they're going to get that money back, and they give you a sum of that, and that is what you get in interest. Well, if they don't get their money, and we don't pass, or we don't raise the debt ceiling, all of that trickles down. And that's just on an individual level. Remember, other countries are also relying on that debt payment and those interest payments to function. So that is what is going on. What should you do to get it passed? Honestly, I can't tell you. A lot of times it just runs up into the ninth hour, the midnight hour, whatever, and they end up passing it anyway, and it becomes something of political theater. I hate it. You probably hate it as well. But that is the situation that we are in. So now you know where we spend our money, how we got here, and what is going on currently. The last thing I'll bring up is whether or not it is important or stressful or strenuous that the U.S. debt is at $1.4 trillion. That does sound like a lot of money. It is a lot of money. However, it's really about how much debt you have compared to what your GDP is, how much you are producing as a country. And right now, that is relatively low. That's like saying, you know, I have a $100 credit card bill. Okay, that's not a big deal if I'm making $100,000 a year, right? It's there, and it could be $2,000, right? It's an increase significantly, but I'm still making $100,000 a year, and that's not anything to be as concerned about. So right now, I think our federal debt is about 3% of GDP. Don't like it there. Sounds like a big number, but again, 3% compared to what I make, that means I got 97% that I make more than what I have in debt. Then I'm probably going to be okay. So always keep that in context. Obviously, we like to go back to the early 2000s, late 90s. We had no federal deficit. That's where we would like to be. To get there, we got to bring in more taxes and manage those expenses a bit better. So that is how you solve the problem. Are they going to listen to me? No, they're not. But the math is the math. All right, that is it for me. I will talk to y'all later.